Hey, Real Vision, it's great to be back with you. I'm sitting down today with Ed Nwokedi, the CEO and founder of RedSwan. RedSwan is one of the most ambitious and exciting projects in the world of real estate and crypto today. I'm super excited to have this conversation. Ed, welcome to Real Vision.
Thank you, Nick. Happy to be here.
So, Ed, one of the things I wanted to ask you about before we get into the background of RedSwan is your first foray. This isn't your first time working in the technology sector, and it isn't your first time trying to connect the technology sector to a real world business. So why don't you tell us briefly the story of your first adventure back in the days of, I guess, Web 1.0?
Well, I was in the automotive sector, and I had started a company back in 1985 by buying into an existing brick and mortar automotive repair shop. And this shop repaired collision damage. I knew nothing about, collision repair. I'm not a skilled person with my hands, but I'm, from Detroit, and I'm intrigued by cars and automotive altogether. And so I bought this company because I can buy the business as well as the real estate. And I thought I could make a difference. And so the first thing I did was, throw away all the old parts and, put in computers and try to automate the business. But after 5 years of this business, we kind of grew it from one location to 7 locations. And I was now starting to have cash flow issues because I couldn't borrow more money to buy more locations. So it was the time to exit. And just before I exited, one of my buddies was the golf buddy, and I was working with a law firm called Wilson Sonsini, which was doing a lot of .coms at the time. And he thought that we had a pretty good model to create a .com centered around collision repair. And so we did. It was kind of based on logistics of parts. That product was, our company was founded, and I was a co-founder. We raised about $95 million. We hired about 210 employees, and we were out there looking to become the next best a billion-dollar company in the marketplace. And then we wound up having to, sell to a Fortune 500 company because the .com market was kind of slowing down in year 2000. So it was still a good exit for me, but that was my real first experience into moving from brick and mortar into tech.
And let's talk about RedSwan, because I did some research on this project in preparation for this interview and this discussion. And from what I can tell, RedSwan is really one of the most ambitious projects out there. And so I'm curious, excited to dig into the details. But why don't you give us a brief overview of it?
Overview of RedSwan. Well, we're a marketplace that focuses on commercial real estate, digitized commercial real estate. This is really an attempt to, create content onto the blockchain of commercial real estate, as well as provide opportunities for investors that are more affordable for them to get involved with. Part of my challenges when I was at Cushman Wakefield is that I was selling a lot of high-end properties, more institutional quality assets. And my Rolodex, I would say the top 25 people I call are, your Starwoods of the world, your KKRs, these big companies that can easily write a $40, $60 million check and buy something. But I had thousands of investors calling me who have 2 million, $500,000. They want to invest in a quality property, but they never could really get involved because, they didn't have enough money to be involved, and they can't compete with the pricing of this larger company. So I thought it was always kind of unfair that, the best assets are going to the biggest purse strings, and that the, smaller investors are always kind of chasing after the low hanging fruit, some of the hardest, more risky type of investments. So that was a little bit unfair to me. And I thought if, we can figure out a way to make real estate more affordable and let people come in and crowdfund into investments alongside of larger corporations and institutions, that the smaller investors will learn from them, number one, be protected by their level of expertise in investing, and also have just a much better quality asset to invest in. So that was one of the main reasons why, we founded RedSwan, to close that gap and create that liquidity for investors and for sponsors.
That's great. So the original pain point that you were looking to address was the lack of the inability for smaller investors to get access to institutional quality real estate.
That was the initial pain point that we wanted to take care of. But then we realized on a much greater scale, liquidity was probably the most, the biggest elephant in the room that needed to be solved. And that was, liquidity for investors, LP investors who are smaller investors, as well as liquidity for the sponsors. If you look at the size of the market, there's probably $33 trillion of commercial real estate worldwide. And out of that, there's 35% of equity trapped in that real estate because that's the equity that they buy into. That equity continues to grow every year as the asset improves. But they're not able to pull that equity out because the only thing they can do is sell the property to pull the equity out or recapitalize the property by going to get a new loan and possibly increasing the size of the loan and pulling some equity out that way. But as you can see, that's not pulling out the majority of the equity. It's only pulling out a fractional increase in the value of the equity. So I felt that $12 trillion of locked equity was really a good target for RedSwan to focus on liquidating.
So I think it would be helpful to get into the specifics of how the RedSwan platform works. So my understanding is that it's essentially a tool for existing owners of property to recapitalize all or a portion of their holdings via the marketplace and the tokenization process, right?
That is true. Existing owners will recapitalize usually the entire LP entity that controls the LP shares of stock. They can also recapitalize all the stock for the company, but typically they want to change out the LP shares because that's where their investors are, and that's where the investors need liquidity. Typically, the banks don't want the LP or the GP sponsor to be sold out of the deal because that means they don't have any skin in the game, and that's really the general partners and one of the banks are relying on for the bad boy clauses and things like that. So we take a look typically at the LP segment of it, and we tokenize the entire LP capital stack. That's 100%. And then we usually will sell out up to 90% of that LP stack so that the GP still has 10% of the LP stack and 100% of the GP stack.
Okay, interesting. And how many properties have you onboarded onto RedSwan so far?
We've tokenized 17 assets, just under $2.8 billion of overall value. And that's roughly about $820 million worth of digital securities.
And what kind of properties are these?
All of them are multifamily. I mean, that's the area that we have expertise in. So I spent more of my time focusing on clients that I've done business with that I think I can create value to. So that's why we kind of focus on multifamily initially. But we've recently hired some experts in the office and hospitality. So we'll be doing and bringing on more of that type of product to our platform.
And on these multifamily deals, like what's the return profile look for an investor if they bought into the token? Like let's say you've onboarded the property, you've tokenized it, and now it's trading on the RedSwan marketplace. Like what are investors looking at getting in terms of yield and overall return for investing?
Good question, Nick, but it varies. It varies on the type of property, the location of the property. As you know, more of your core locations, Main and Main are going to have lower yields just because they're less risk. And then your more suburban or tertiary properties are probably going to have a little higher yield because of the fact that there's a little bit more risk. So it really depends. But on average, we're seeing, your core plus type properties with a IRR that's somewhere in the low teens, 16 to 17, and cash on cash somewhere between 4.5 and 6. And then your more value add type properties, which are suburban or older properties that need to be repurposed, you're seeing cash on cash around 6 to 7.5, and the IRR somewhere between 16 and 22. So that's kind of the spread between the high quality assets and also the value add type assets.
What's like the average age? Like, so these are properties that are already owned and controlled by real estate developers and investors. Like, how long have they owned them?
A lot of these properties that we're going after have equity built in. So they've owned them for a few years. When they buy a property initially, their equity is very low. but after 2 to 4 years of operating, they tend to build up higher net NOI and then also a higher overall net equity. So I would say on average, these owned properties have been owned for 4 or 5 years. And now the sponsor is looking for a little bit of liquidity. Typically an investor comes into a syndicated property and the sponsor is telling them that we have a 5-year forecast. So year 1, we make the acquisition. Year 2, we probably start doing some value add. Year 3, we do some value add. And year 4, we now stabilize at a new NOI level. And then year 5, we're probably going to make an exit and bring back your capital and your profits.
And is that true for the deals that you've onboarded? Like, are these all eventually planned to be sold?
No, actually, it's true in terms of the forecast, so that you can look at the value of the asset kind of moving in that timeline in terms of stabilization and value add, and then time for you can make an exit. But because we're digitized, we have digitized these assets. A disposition of the asset is no longer necessary for a shareholder to obtain their IRR. What I mean by that is we don't have to sell the whole asset in year 5 in order for the investors to get their full benefit. Because these investors have bought into a digital platform, liquid shares, they can actually sell their shares anytime they want, anytime after a 12-month seasoning period. So by year 2, even though the asset is still in its development stage, and let's say the NOI has increased just 5% because they haven't done all their stabilization, the holder of those shares can still take their shares and place it on RedSwan and say, I want to sell 20,000 of my shares, and this is the price I want to sell it for, $1.15 or $1.20. And now they can have their liquidity at that level. And in year 5, if everything works out well, as the sponsor has articulated, year 5, the assets be worth a lot more money because the NOI is stronger. And now that same shareholder can say, I'll sell 20,000 shares for $1.50 instead of $1.25. So that's how the liquidity will work for the independent shareholders.
Yeah, this liquidity conversation is fascinating to me because it's the thing that is most needs innovation probably in this whole world is there needs to be secondary market liquidity for all of these projects to make sense. And what is your forecast? I know all your projects presumably are still in their 1-year lockup period, right? So what's your forecast for liquidity, and like how are you basing what are you basing that forecast on?
Well, we have to stay with the forecast of the sponsor. We don't manage properties, so we can't promise anything other than what our sponsor is promising. So if the sponsor forecasts, a 18% IRR in 18 years, what we're doing is tracking the measurement of the performance every quarter and presenting that to our shareholders so they can see themselves how that property is actually performing, and they can kind of reverse calculate what their price point should be worth based on their share ownership.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.